नरघट तक है तेरी कहानी, पग पग प्यारे। दंगल 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 दंगल, सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे। दंगल 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 दंगल।
Great morning, my dear friends. Bhupesh, Anand again. So today we will be starting with lecture number 2, quantitative methods. We are doing quantitative methods. Within that, we are doing time value of money, and we have already covered LOSA in the lecture number 1. And I have told you what are the basic concepts of compound interest, what are the basic concepts, how to use a financial calculator, and what is the meaning of a time value of money. Why you cannot have a breakfast meal today at $100, which you can have, which you can purchase at $100 today. Why you cannot have that the same meal after 1 year at $100? The same McD, the same breakfast meal, the same contents, but you cannot purchase at $100. So let me start with the basic logics that how this McD cost is being increasing, why there is an inflation, and what are the different components of the required rate of return we have discussed in the last lecture. So let me move to a very interesting part today, and that is learning outcome number B. Explain interest rates as. We have discussed in the learning outcome A that interest rates are represented as required rate of return, discounting rate, opportunity cost. Now we are in LOSB. We want to explain that the interest rate which we are talking of, that interest rate is a mixture of 2 or 3 things. Rather, I will say it is a mixture of 5 items. The one is the real risk, inflation, and default risk premium, and this liquidity risk premium, and maturity risk premium. We will be discussing with Irving Fisher. Irving Fisher, you have heard of Irving Fisher theory. We will be doing with Irving Fisher theory. So please take out your registers. Learning outcome number B. Explain interest rate as the sum of, it means the total of real risk-free rate and premium. The real risk-free rate and premium that compensate investors for bearing risk. I repeat, learning outcome number B, explain interest rate as the sum of real risk-free rate and premium. It means if you want to calculate the interest, it will be total of real risk-free rate plus premium, risk premium for different. So how it is same. So for that I am going to start with the lecture. Very interesting, very important, and very you will enjoy this lecture. Please be attentive. Please take out your registers and you have to note down all the points, all the handwritten slides which I have given to you. Now, what is the meaning of real risk rate? I have told you, I will be telling you with the help of this case study, but for calculation, for just writing sake, you have to write down. It is risk-free, real risk-free, just like real juice, Dabur real juice, real risk-free rate. It is the theoretical rate on a single period loan when there is no expectation in inflation. So these words are important. Even if you are not getting anything, please write down for 2 or 3 slides are there. It means it is a risk-free rate, it is a theoretical rate, it is a theoretical rate, it is a theoretical. It means we calculate in theory on a single period loan. On a single period, and we assume that as if there is no inflation, then how much is the rate we can earn? That is named as real risk-free rate. I will be coming to that. No need to worry. Just write on point number 2, nominal risk-free rate. Now, what is nominal risk-free rate? As per Irving Fisher, it is a composite of 2. One is real risk-free rate plus inflation. One is real risk-free rate plus inflation. So I have written real risk-free rate plus expected inflation rate. So that total, banking people, or the rate which is there in the market, that is nominal rate, which is a composite of real GDP, real rate plus inflation. It means if you are going in a banking company and you are asking for how much is the rate of interest for FD, so those people, they are giving you the interest rate 10%, 12%, 13%. No, that is nominal rate of interest. When I say nominal, it is a composite of 2. One is real risk free. I am not aware. I don't know what is the meaning of real risk free. I will be telling you. Plus inflation rate. If we combine these two, that will be named as nominal risk free rate. So let me move to third point. The last slide you have to write on today. How many types of risk premium, or what are the different types of risk which an investor has to face? If X is investing somewhere, then what can be the different types of risks which an investor has to face? That we have to see. So different types of risk in a security. There are three types of risks. One is default risk. For example, if I am investing, or if I am investing in a bond, or in a of a security, or in a security, then it can be possible that interest payment on that bond or the maturity amount is not being payable to me on time. That is named as default risk. It can be possible, as in case of Kingfisher Airlines. Kingfisher Airlines, Vijayamala has not paid the interest as well as principal to the bankers. That is a default risk. Second is liquidity risk. Supposingly, I have purchased an investment, and if I want to sell it because I require some funds immediately, and if I cannot sell it, if it cannot be converted into cash, it is named as liquidity risk. And maturity risk. At the time of maturity, I am not getting the money back. So there can be three types of risk which an investor has to face. So for that, he will be expecting some premium. So I think I have not told you anything. I have even not explained you. I will be explaining you with the help of a case study. So what is required rate of return? Higher the risk, as I have told in the last lecture, more is the risk. The risk premium is the function of riskiness of an investment. I repeat, risk premium of an investment is riskiness, is a function of riskiness of of that investment. It means higher the risk, high will be the risk premium. Lower the risk, low will be the risk premium. So last point which I want you to write down, even if you are not getting anything, my humble request is just write on these 4 points, because then after that I will be telling you the case study and I will be explaining all these concepts. What is required rate of return on a security? It means what are the expectations? What is the minimum expectation? What are the minimum expectations of investor? What he want, as that he should be compensated with this much at least rate of return, and that is named as required rate of return. So please write down the formula. It is sum total of 5 items. One is real risk free rate. Second is expected inflation. Third is default risk. Fourth is maturity risk. Fifth is liquidity risk. So for that risk, he will be charging some premium. So I have added premium. So real risk-free rate plus expected inflation plus default risk premium plus liquidity premium plus maturity risk premium. I don't have the space, that's why I have not written the word premium. Please write down maturity risk premium. And now I am on the case study which I want to tell you, with the help of which I will be giving you two case studies today. And mind you, those two case studies are mind-blowing case studies. If you easily, if you sincerely, for coming 5 minutes, if you are very much sincere, the whole lecture, the whole learning outcome, the whole time value of money concept will be very much clear to you. For example, in this first case study I have given, that Ramlal has $100 in his pocket and he wants to have a breakfast. He's feeling hungry. No, because he has attended time value of money lecture number 1, or because of any other reason, he don't want to invest. He don't want to spend $100 in his meal. Rather, he wants to invest, because he wants to have an income on that. So he has entered into, or he has invested into bank FD for 1 year at a rate of interest, and he is getting $110. Supposingly the rate of interest is 10%, and supposingly he has $100 in his pocket, and supposingly he is sacrificing his current consumption. The word is sacrificing his current consumption or deferring his consumption. He want to consume that breakfast, but he is not consuming from McDonald's, and he is not consuming from any other place also. He is keeping himself hungry. Rather, he has invested that $100 in a banking company, in a Bank of America for 1 year. Let the rate of interest be 10%. It means after 1 year, he will be getting $110. Now, what he will do with $110? He will take $110 and he will run to a McDonald's. He will take $110 from a banking company and run to McDonald's for the same breakfast. But my dear sir, that McDonald's, they have increased their prices. Now the same breakfast which was available at $100 1 year back is not available at $100. Rather, it is available at more than that. Let it be available at $107. Let it be available at $106. Let it be available at $105. So that increase is due to inflation. It means his real saving is not $10 because he has received $110 from a banking company and he has invested $100. So his income is $10, but actually he has not earned $10. Actually, he has earned only $3. That is a balancing figure. If he is able to purchase that breakfast meal at $107, it means a balancing figure $3. That $3, that is his real income because 7%, because the $7 he has to pay for inflation. You're getting my point? So please write down, my dear sir. Ramlal has $100 in his pocket which he wants to spend on his McDonald's breakfast meal, but he, due to some reason, wants to defer his consumption. Defer means Ramlal will consume today's breakfast after 1 year and he is hungry today. So just see, he has deposited $100 in Bank of America today at T0 at 10%. So how much he will be getting? Future value is $110. Now what he will do for with $110? He will run to McDonald's and ask for the same breakfast meal. But the same breakfast meal supposedly is available at $106. So out of $110, he has to spend $106 for buying that breakfast meal, and $4 will be his real saving. So that's why I have written there $110. I have bifurcated into two parts. One is $106, second is $4. $4 is the real saving. 10%, the interest which he has received from a banking company, that is named as nominal interest rate. Now, nominal is being bifurcated into two parts. One is real risk-free rate, and second is inflation due to inflation. So, in my example, I have taken 6% as inflation, and 4% is real risk-free. So, just write down this flowchart. My dear friends, I have prepared it for you only, with the help of risk-free, real risk-free. So this 4% is also named as real risk-free rate, 6% is inflation rate. So 10% is equal to nominal rate as per Irving Fisher is equal to 6% plus 4%, that is expected inflation, plus real risk-free. So I have told you that interest rate is a mixture of, it is a sum of risk-free rate plus the premiums. So I will be telling you something more than that. The last point, which is my learning outcome, that interest rate is the risk-free rate plus risk premium. So how many types of risk premiums can be there? How many types of risks can be there? Again, I have already told you default risk, liquidity risk, maturity risk, but for that I am taking a case study that why I want to add it. What is the intention behind that? What is the logic behind that? Why we are adding that risk premium, you should be aware of. So for example, Mr. X, again Mr. Ramla has $1 lakh as he wants to invest. Now he has four options. One option is he can invest in a government security, that is in a sovereign bonds that is issued by government of any country, or he can invest, he can advance, or he can invest in a bank FD, $1 lakh in Bank of America, and he can invest, he can give a loan to an individual. Let it be Ratan Tata, let it be Trump, let it be Vijay Mallya. And fourth is he can invest in equity. Now these are the four options. Now please see the intent behind that. Now if you have $1 lakh and you have the four options, supposing you have opted for first option, that is you have invested in a government security, in a sovereign bond, then how much will be the expectations? How much you will expect from there? That expectation which you expect from there, that is nothing but required rate of return, and that will be helpful to us in formulating the formula. So just write down last case study. Ramlal has 1 lakh to invest. Following are the investment options. So these are the four options. The first option is to invest in government bonds, sovereign bonds, and when I say government bonds, I mean risk-free. But if I see the latest case study, the Russian government and Argentinian government, even the government bonds, even the sovereign bonds are not risk-free. But for theoretical purpose, we are assuming that these bonds are risk-free. Argentinian, please read the have a case study from Google Baba. Argentina and Russian, they have not paid the bonds. They have not repaid that. So we are not going in that detail that I will be discussing in fixed income and equity. Option 1 to invest in government securities. Option 2 invest in fixed deposits. And option 3 to invest to a well-known person, not Vijay Mallya, let it be Ratan Tata. And fourth is he can invest in an equity. Now the point is he has four types of investments. Now what he will expect from these investments, what is the intent behind that, that we will be watching with. Now please prepare this flowchart. What are his expectations? So expectations of Ramlal in regard rate of return. Expectations of Ramlal in regard to rate of return. So he will have different expectations for different investments. In case of government security, in case of sovereign bonds, in case of risk-free security, supposingly I have written there real rate with 3% and let the inflation rate be 6%. So his expectation will be 9%. That is required rate of return in case of a government security. But in case if I go in a bank deposit, banking company is more riskier as compared to government security. As in India, the RBI, the central bank, only give the guarantee of 1 lakh rupees as a deposit, as a security, as a guarantee. In case any banking company defaults, then RBI will only pay 1 lakh rupees. So as compared to government security, banking company is somewhat more risky, I will say. So he will add a risk premium for that, and let that risk premium be 0.25 basis point. So his rate of return, his expectation from banking company will be 9.25%, because 9% is from government securities, so 0.25 we have added for more riskier. Now in option number 3, he has invested, he has given a loan to a person, to an individual. Now that individual may be a well-known, but that can be a, that involves more risk. Just see in case of Vijay Mallya, the risk premium is infinity. He has flown to London. So in case of third, in case of amount lending to a person, to an individual, the risk premium will be more higher as compared to a bank, because there can be default risk, there can be liquidity risk, there can be maturity risk. So let that risk premium be 0.75 or 75 basis point. So in this case, his expectation in regard to required rate of return will be 9.75. So I am into last point, when he has invested in an equity. Now it depends, equity, which type of equity, whether he has invested in Kingfisher Airline, whether he has invested in Satyam Computers, whether he has invested in Sahara International, or whether he has invested in Infosys, because everywhere there are the different incidents of risk and riskiness. The risk premium is a function of riskiness. Risk premium is a function of riskiness. So higher the risk, high will be the risk premium. So I have assumed let the rate be risk premium of that equity be 4%. So he will be expecting 13%. It means he is the same person. He has $1 lakh, but he has invested different. So his expectations are different. So I want to tell you that interest rate is a sum of risk-free rate plus different types of risks premium. Now it depends from person to person, it depends from party to party, or it depends from investment to investment. So let it be note number 1. I know that you know that, but I want to just give you one point regarding default risk. That what is the meaning of a default risk? That this person has given. For example, in case of Vijay Mallya, Kingfisher Airline, you can easily understand what is the meaning of a default risk. Making default. Liquidity risk. I want to sell that asset, but I am not able to sell that stock. In case of real estate, you can easily find out that what is the meaning of a liquidity risk. So because of these risks, some premiums are being added. And higher the risk, high will be the premium. And the third is the maturity risk. That on maturity, for example, I have invested in a bond of a company, Ranbaxy Laboratory, and whether that Ranbaxy Laboratory will be paying me back that bond on maturity, that maturity value will be given to me or not. That is maturity risk. And longer the maturity, high is the risk. For example, I've given the example of two bonds. Let bond X be there and then bond Y be there. If the maturity in bond X is 3 years and in case of my bond Y it is 7 years, then in case of bond Y, there is a high incidence of maturity risk. You're getting my point? So I am again moving to that point that required rate of return is equal to interest is equal to real risk free rate plus the component of risk premiums. So this is the formula which we have discussed and the logics we have discussed. Let me move to Google Baba. That what Google Baba is saying to me, nominal return. I have asked the question, what is the meaning of a nominal return? The return on an investment without adjusting for inflation. It is calculated simply by taking the dollar amount of the return and comparing to the amount invested. A higher nominal return does not guarantee a real profit because it is a composite of inflation also. That's why it does not guarantee that. So in this nominal rate, let us see in the from Investopedia that what is the meaning of nominal rate of return. Nominal rate of return is this investment fees and inflation and all, breaking down nominal rate of interest, nominal versus after tax rate of return, and why there is a risk, due to risk premium. Now, what are the different types of risk premium which are there? Risk premium. I have just told you there are three types: risk compensation, because there is the risk that has to be compensated, and because that has to be compensated, the expectations will be more and the investor will expect more, will have a required rate of return more, earning reward, premium cost. So all that I have just discussed, the same point is there. So we have discussed, learning outcome number B also. So this is my lecture number 2. Hope you're enjoying it. Be happy, be jolly, be cheerful. Be happy, be jolly, be